this conversation ahead, we're joined by Sandip Agarwal, who's the fund manager at Sowilo Investments Managers, joining us now. Sandip, thank you so much for taking out the time. I think it's really important for investors to understand right now as to what they need to do with their IT holdings. I was just reading up, and since January, if I'm not wrong, FI selling has been around that 18,500 crores and 11,000 crores in last 15 days itself, with every development that has taken place, globally in the last 15 days with regards to AI, with regards to, the recent Citrini report that also flags that, contracts are being cancelled for companies like TCS, Infosys, as well as Wipro because of AI coding collapse is what we're seeing. How do you read this? What sense do you make out of all of this? And how should an investor look at IT companies at the moment?
Hey, hi, good afternoon, and thanks for having me on the show. So, if you see the disruption, which is the recent one, the AI led, and our IT industry, which has seen in last 3 decades more than 5-6 such disruption.
Yeah.
But in technology, what has always happened is that, every disruption, more work, after every disruption, more work has come, more volumes have come. So basically what happens is your efficiency goes up and experience improves. This is the first disruption where efforts are going down by 20-30%. So it is deflationary in nature. And fortunately for us, it will be spread over for 4 to 5 years. At the same time, it also means that, we will be having pressure for a long period of time. That means lower growth for a longer period of time is what will happen. So last 14-15 months back, if you see when this disruption was coming, the industry's PEG ratio was very, very high, because for companies with 4-5% growth, the multiples were 27-28 times. For companies with 12-13% growth, the multiples were 45-50 times. So sorry, we have huge concern that this kind of PEG ratio is unsustainable. With the recent correction in last 14-15 months, almost I think the index is down by 40%. I think large part of the correction is behind for the large caps, although last 5-7% correction cannot be ruled out even from the large caps. There is still a lot of valuation mismatch in the mid cap space, particularly the ER&D companies, because they are trading at very, very high valuation, and they are a natural beneficiary of what happened in Ukraine-Russia war also. So when that war cools down, then I think again, there will be a big decline in their revenues, which I believe should happen. So I think the ER&D companies are still insanely priced, but broadly within the large cap space, I think with today's correction, I will not be able to call out whether it is a bottom, but I think now they are looking more constructive. I don't believe that the revenues for large cap companies will decline in absolute terms. Even the margins will not see any impact. So I think from this level, they are getting into the attractive zone of 10 to 15 times multiple for a 5-6% growth because of the good corporate governance, the rupee benefit which happens. Mid cap, the growth is also higher, 10-12%, and the multiples are still maybe 25-26 times. But so there is some correction which is due. In some of the pockets in ER&D, the multiples are irrational, and I think there is a space where 25-30% correction is due. So we will categorize that large cap are broadly there, 5-7% more downside. Most of the IT services mid caps are also okay, but the ER&D companies still, I think at least 25% more correction should happen.
Oh, interesting. 35% more correction. Is that correct? Did I hear that correctly?
25 to 35.
25 to 35. Okay, all right. Sandip, the aspect that you mentioned about with regards to how deflationary pressure is there on all of these large cap names, I was reading a very interesting headline today which said that, overall we might see pressure on tech companies, but overall companies spending on tech is going to increase, right? So there is two sides of this. How do you read that?
No, absolutely. So as I said, volume will go up.
Yeah.
Tech spends, if you see last 2 decades have been broadly same, like 2-3% growth is only there. So I don't see a big jump in growth, but at the same time that, whatever the client saves in the budget from the deflation, they will obviously allocate that money to improve some other part of their IT infrastructure and applications. And also, that's why I'm saying I don't see any risk on the business model of the Indian IT services companies. I do see risk in the multiple. Now that risk is also largely behind. Last 14-15 months, almost the index is down 40%. So I think it is now entering a very comfortable zone. Although little more downside could be possible, but I am not at all of the view that, like what software is going to face, same thing we will face. So in software, it will be immediate and sharp decline and some of the business models will collapse. But the services side, which is basically the layer on top of that, I don't see any risk there of the business model. But yes, the growth will be lesser and for a longer period of time, and the multiples will also derate. So fortunately, in this move which has happened in last 14, 15 months and last 2 months especially, lot of that thing has been built in and they are now more reasonably priced. And in coming days, I think as numbers starts coming in, there will be more correction and they will get more repriced in a better way.
Okay, interesting. Sandeep, the elephant in the room right now is AI. Everybody is talking about it. With IT companies also now improving in terms of disclosures with regards to their AI income. If you were to play this theme via Indian companies, how would you do it?
So the right now the way last 14 months we have played is through cables and transformer companies, and it has done phenomenally well. Recently, the last 6 months, we have a very small position in one very small listed company, which is doing some work in AI, and it was at a throwaway price, so we bought that, and that is the only holding that we have been giving as disclaimer that we have a very very small tech position, because 15 months back we zeroed our tech position and we just had one or two very small position, very small companies. There is not much listed software company in the AI space where you can play directly. So we played through cable transformer and all. Now, with the correction which has happened today, I feel more comfortable, and maybe going forward in next few days, we will start nibbling some of the IT names. We will start with the large cap because they are more reasonably priced. And probably, except ER&D, we will probably nibble everything around in the mid cap also, because now valuations are coming to our comfort zone. We are of the view that large cap will continue to grow at 4-5% with 4-5% rupee depreciation benefit. So 8-9% kind of EPS growth is possible, and for that we are okay to pay 15-16 times multiple. And similarly for mid cap, 10-12% growth, 17-16-17% PAT growth, we are comfortable to give 20 times, 18-20 times. So I think we will get in some time prices there, and we will be happy. So I am now very much more constructive than earlier. I think the large part of the correction is behind. It doesn't mean that nothing will correct from here. From here also there will be correction 5-7% in the large names, but you cannot time the bottom. So we are more constructive from here on.
Okay, Sandeep, one last question. Considering the 5 to 7% correction in the mid cap space and slightly higher correction in the mid cap space, any names that you would be looking at after that correction that you would be buying in, both in the large cap as well as mid cap space?
So we run a PMS. I will not be able to give you a name, but I will say large cap is broadly becoming attractive. So we will be just going by the companies which have good management and growth better than the other. That will be our preference. What we will not buy, I can tell you, we will not buy ER&D at current valuation. ER&D, I think there is massive bloodbath to happen still from here. 25% is a big number. I think 25% is bare minimum correction which will happen in ER&D companies, and the day when Ukraine and Russia war starts going down, or means it gets resolved, these companies will have big challenge, because they have benefited a lot at the cost of EPAM and Globant and all. So that will also reverse.
Right. Okay, Sandeep, thank you so much for taking out the time and speaking with us at NDTV Profit. I think the key takeaways from this conversation would be that, he did mention that, the worst is behind. Of course, still 5 to 7% correction is something that you can expect from the large cap names, and certain correction in the mid cap space as well, but stay away from ER&D companies in the tech space is what Sandeep is suggesting. So that's the view.